Welcome to the pre-scene analysis of paper SL1 Advanced Business Reporting. So I'm going to look at the financial reporting part of the paper, which consists of 55% weightage when it comes to the examination. So I'm not going to go through the case study because I'm pretty sure you have gone through it many times, analyzed it. So what I did was the relevant areas of the case study I have taken into the PowerPoint presentation itself. So the session plan is I prepared a PowerPoint presentation which consists of little more than 50 slides. We'll go through the presentation first. Then at the end of the presentation, I'll allow you a question time where you all can clarify your doubts. Moving on. So the first important information in the pre-scene with regard to the financial reporting is, so this company, HCL, got a letter in the last financial year, right, from the Sri Lanka Accounting and Auditing Standards Monitoring Board identifying several non-compliances with regard to the accounting and the fair value measurement. Okay, accounting and fair value measurement. So that is in the last financial year. So when you are preparing the financial statements for the current financial year, you need to ensure that these non-compliances are no more there, right? So the standard applicable for the fair value measurement is SLFRS 13, right? So by keeping that thing in mind, before moving to the technical aspect of the standard, if I go through the financial statements of HCL, right? So you have been given the all important financial statements. So that like current year numbers, that is 31st March 2020, as well as comparative period 2019. And important thing, what you need to note down here is 2020 numbers are still what? Unaudited. That means maybe during the audit process or maybe during the uh, financial statement closure process, entity might identify some accounting adjustments, which might need to incorporate into the unaudited financial statements before finalizing. So before you prepare the consolidated financial statements by using the given set of information, so these adjustments might have been included. So we look at what are the areas where these adjustments can be tested in the exam. So first of all, what is given is the income statement. So you have the normal components like revenue, cost of sales, GP, other operating income, selling and distribution expenditure, administrative expenditure, operating profit. Thereafter, the finance cost and the finance income, PBT, income tax expense, and the profit for the year. Earning per share and the dividend per share information is also given, right? Then you have been given the statement of comprehensive income, which includes the profit plus the other comprehensive income. So when I'm going through this financial statements of the company, I need to now highlight what are the areas where the fair value adjustments are required. Okay. Now, under the other comprehensive income items, first of all, you have a cash flow hedge here, right? We know that under the cash flow hedges, hedge instrument needs to be measured at fair value, and the fair value gains and the losses are taken to the other comprehensive income, right? Then, so the other comprehensive income items are classified into two groups. Other comprehensive income items, which can be reclassified to the income statement in subsequent period. Under that only you have the cash flow hedges. Then the other comprehensive income items, which will not be reclassified to the income statement in a subsequent period. Under that, you have three items actually. One is net loss of the financial assets at fair value through other comprehensive income. So you measure the financial assets at other comprehensive income, and the value changes in the other comprehensive income you have taken to the other comprehensive income, right? So the financial assets at fair value through other comprehensive income. The next item is actuarial gain or loss of a defined benefit obligation. This is under LKS 19. Okay. So the final one is revaluation of land and building. You know, revaluation means again it's a fair valuation of land and building. So the areas where the fair value adjustments, value changes are recorded is one is because of this revaluation gain or loss of land and building. Then the fair value gain or loss of financial assets, which are measured at other comprehensive income. Then the hedge instrument of the cash flow hedge is to be measured at fair value. So the fair valuations are there in all these areas. Then you have the total other comprehensive income. After that, finally, total comprehensive income, which is the profit for the year plus total of the other comprehensive income. Then if I move to the changes in equity statement of the company, this is actually taken from the changes in equity statement, because what you have is the reserve balances. Okay. So, what are the reserves that they have is, first of all, other capital and the revenue reserve, then the revaluation reserve. Okay. So that is because of the revaluation of land and building. Fair value reserve. This is because of the fair valuation of equity financial assets, or the financial assets which are measured at fair value through other comprehensive income. Then the cash flow hedge reserve, again as a result of fair valuation of the hedge instrument of the cash flow hedge. Now it's very clear that in the financial statements, a lot of fair valuation is involved. Okay. Then moving on to the statement of financial position as well. So the PP&E, within that land and building is fair valued, and companies having an investment property. So the investment properties can be measured at fair value subsequently, and the fair value gains and the losses are taken to the income statement. There can be an impact on that. Then you have a lease here, like leasehold right. Then intangible assets, subsequent measurement can be measured at fair value or the revalued amount, which means it is fair valued. Then investment in this Bangladeshi operation, okay, Bangladesh investment, so 35% acquisition. Then financial assets. So the certain items of the financial assets can also be measured at fair value. So these are the areas where the value adjustments are required. Then current assets, where you have inventory, trade receivable, tax recoverable, other financial assets, maybe some items to be measured at fair value, cash and short-term deposits. Then what we have is in the following slide is the equity section, share capital and the reserves, and the non-current liabilities and current liabilities. So under the non-current liabilities, interest-bearing loans and the borrowings, financial liabilities, deferred tax liabilities, employment benefit liabilities. Under the current liabilities, trade and other payable, income tax liabilities, interest-bearing. This is the current portion of the interest-bearing loans and borrowings, and the bank overdraft. Right now, I looked at where the value adjustments are taken place in the financial statements. Now, moving to the discussion, as I mentioned, if companies having property, plant and equipment, in this case land and building, right, companies following the revaluation model. So company can make a policy decision for each class of PP&E item whether to use the cost model or the revaluation model. Okay, so that decision has to be applied to the entire class. Now if you decide to revalue the land and building, you have to revalue all the land and building that the company has. Okay, so the relevant actually practical scenario in the Sri Lankan context to the given case study is HEMAS, right? So in HEMAS, actually what they are doing is land and building, they follow the revaluation model. Okay, so the revaluation model means you revalue the particular property, land and building. That revalued amount you depreciate over the remaining useful life. If there are any impairment losses, you recognize. And when you are using the revaluation model, you need to ensure that there shouldn't be a significant difference between the carrying value in the financial statements and the current fair value. That means you have to do the revaluation with sufficient regularity. Okay, so in the unseen, you have to look at if that information is given, whether the company has done the revaluation with sufficient regularity to ensure that there is no significant difference between the carrying value of the land and building in the financial statements and the fair value of the particular property. Then the second item where the fair value adjustment can be tested is with regard to the intangible asset. Actually, with regard to the intangible asset as well, two subsequent measurement models are there, cost model and the revaluation model. In the revaluation model, it is same as the revaluation model in LKS 16, property, plant and equipment. So the intangible asset is LKS 38. So here also, you fair value the intangible asset if you use the revaluation model, and the revalued amount you amortize here, amortize over the useful life, and recognize the impairment losses, if any. But here there is very important point that you need to understand is, for you to use the revaluation model with regard to the intangible assets, you have to ensure that company is having an active market. Okay, company is having an active market. Without having an active market, company can't use the revaluation model for the intangible assets. Right? So in the exam paper, if examiner has given a scenario where company is using the revaluation model for an intangible asset which doesn't have an active market, that is wrong. Then there's a accounting matter, or it can lead to auditors have identified that. Okay. Now, again, if you look at the context of HEMAS, what they have is on the balance sheet of HEMAS, they have a consolidated goodwill figure. That is an intangible asset as well as brand value. Okay. So these items, HEMAS is carrying in their financial statements at cost. Okay. So because it's very rare to use the revaluation model for the intangible asset, the companies, because for intangible assets, very rare to find an active market. Okay, because intangible assets are unique. For unique assets, difficult to find an active market. Okay, so that can be a point where you need to focus on in the exam. Then I talk about the investment properties, right? With regard to the investment properties, what I told you is, right, with regard to the investment properties, again, subsequent measurement model can be the cost model or the fair value model. So again, accounting policy choice. Right? If you use the fair value model, you fair value and the fair value changes are taken to the P&L here, profit and loss here. Okay. And also, not only that, if you use the fair value model to measure the investment properties, there is nothing called depreciation. So the applicable standard is LKS 40. No depreciation, fair value gains and losses, unrealized fair value gains and the losses are taken to the profit or loss if you use the fair value model. The cost model is same as the cost model in LKS 16, property, plant and equipment. Cost minus the depreciation, minus the impairment losses. But our focus here, as the non-compliance is with regard to the fair value measurement, about the fair value model. In addition to that, we looked at, in this question, there is a reserve called fair value reserve of the financial assets. Right? So entity, if the entity invests in equity financial assets, so there are two classifications where a company can do. One is fair value through profit or loss, FVTPL category. The other one is fair value through other comprehensive income, FVTPL or FVTOCI. Some people refer this as FVOCI. Right? Both cases, the important point is you fair value the investment. Right? Then the normal expectation is all the equity financial assets to be measured under the designation of FVTPL normally. But company can designate the equity financial assets, equity financial instruments under FVOCI category if two conditions are met. What are these two conditions? If you can prove that you are holding this equity instrument not for the trading intention, I don't have any trading intention, as well as if you put under the FVOCI category, it's an irrevocable choice. You can't reverse your choice. If you put it under FVOCI, that's it, irrevocable choice. As well as that designation under the FVOCI to be done at the initial recognition. On the day one itself, you have to put this under the value through OCI. Put it under FVOCI on day one. After you putting it under FVOCI, it's an irrevocable choice. You can't come back and say that, okay, I want to reclassify this into the value through profit and loss. That is not possible. If these two conditions are met, right, both these conditions are met, then you can classify the equity financial asset under FVOCI. It seems that this organization has done that. So that's why they have, under the other comprehensive income, there was a loss of the during the financial year, value loss under the other comprehensive income, and there's a balance in the cash flow, or there's a balance in the value hedge, value reserve. If I go back here, so there's a accumulated loss in the value reserve. Okay, and also under the other comprehensive income over here, you have a loss with regard to the fair value measurement of the equity financial assets. Okay, right. Not relating to the cash flow hedge reserve. Cash flow hedge reserve is something else. That is this. Okay, cash flow hedge reserve is something else. So about the cash flow hedge, how the value gains and the losses are created, we'll discuss in a little while. Now I'm coming back to the place where I was at. Okay. Now, what I wanted to highlight is, okay, these are the areas which you need to focus on with regard to the value measurement. So the guidance in the standard is, so now different standards requires items to be measured at fair value. Now, when different standard requires item to be measured at fair value, how to decide how to measure the fair value is not guided by those standards. How the fair value is determined is guided by this special standard that talks about fair value measurement, which is SLFRS 13. So the role of SLFRS 13 is actually when a particular or a separate standard require item to be measured at fair value, SLFRS 13 provides on guidance on how to fair value the item. Right? So it's a single source of guidance on how to measure the fair value. Right? So what SLFRS 13 says is fair value is a market-based concept. It's a market-based concept, not an entity-specific concept, So in the exam, you might have a scenario where company management has used their own valuation method to measure the fair value of one of the items what I have mentioned earlier. Then what you do? Understand here is, okay, whether they have done the valuation as per the guidance given in SLFRS 13, because SLFRS 13 specifically mentioned that you can't use your own valuations. It's a market-based concept. So market-based concept means when you are determining the fair value, as much as possible, you need to use observable data, which is available to the market participants. And also these observable data, as much as possible, to be taken from the active market where the transactions are regularly taken place. Okay. So then this standard talks about the inputs that the organizations should use for the value measurement. So these inputs actually categorized into 3 levels. This is also called as actually fair value hierarchy. Now, the inputs that you take into the valuation are 3 levels: level 1, level 2, and level 3. So the level 1 inputs are the inputs which has highest quality. So to classify something as level 1 input, it has to be a quoted price for an identical asset in an active market. Example, what I can give you is, if you hold the shares in a listed company, invested in a listed company, to measure the value of this investment, you have quoted prices in the Colombo Stock Exchange. Identical asset, your shares and somebody else's shares, which are getting traded in the stock exchange, are identical. Active market, there are frequent trades taken place. So market is active. So if you use that input to measure the value of your investment in this equity financial asset, you consider this as a level 1 input. Right? Then hierarchy in the sense, if you do not have level 1 inputs, then only you go for the level 2. While having level 1 inputs to measure the fair value, you can't go to level 2 inputs. So the level 2 input means, if you don't have level 1, I now go to the level 2, which means, important word, observable prices. These are observable to the market participants, but they are not level 1. So basically, you don't have all the 3 conditions what it has to be there in the case of a level 1 input. For an example, level 2 means quoted prices for what asset? Similar asset, not identical asset in an active market. So it's similar asset, you see, not identical. Or else quoted prices, identical asset, but the market is what? Less active. Or else it would be any other observable input which are not prices. Good example what I can give you is, let's say I need to measure a fair value of a property. I can measure now let's say there's a property in a urban area. So there are recent transactions with regard to the similar properties have been taken place in the past. And also I know the price per square meter in that area. So by using those data, what I can do is you can measure the fair value by using the observable input to the other market participants as well, not only for you, right? Not only for you, right? Then if you don't have level 2 inputs, then you go for the what? Level 3 inputs. Okay, that is the hierarchy. Level 3 are unobservable. That means those are entity specific. Market participants can't observe it. Good example what I can give you is when you want to measure the value of one cash generating unit that is there within your business, you prepare a cash flow forecast by taking the present value of the cash flow forecast which you prepare for maybe for 5 years. You take the value of the cash generating unit. Now this data what you used for the calculation of the present value of the future cash flows are unobservable to the market participants. It is available only to you, right? Now, the growth rates that you have taken, discounting factor that you have used, it is available only to you, right? That is level 3 inputs. So I have given these 3 examples, what I have mentioned in this slide, okay? So you all can go through, right, to explain you all the fair value hierarchy. So as I mentioned, the question can be tested from the area where entity has not followed the correct hierarchy of the fair value measurement. Then you need to explain that is wrong, and this is how the correct way of measuring the fair value by using the value hierarchy in SLFRS 30. Right. Then the deferred tax. Why I said that deferred tax is because in this particular scenario, a lot of items in the financial statements have been measured at fair value. When you measure the fair value of an item, right? When you measure the value of an item, so the carrying value of the item is getting changed, right? Now, in the concept of deferred tax, what we focus is on the carrying value and the tax base. Now, if the fair valuation increases the carrying value of the item, where the tax base is not affected by the fair valuation because inland revenue people or the tax person doesn't take the fair value into account to calculate the tax base. For him, the tax base is the cost minus accumulated depreciation or the cost minus accumulated capital allowances, right? But for the carrying value, fair value, valuation, if the value gain is recorded, carrying value will increase. That would create a temporary difference. Now, if I take the example of a revaluation of a property under LKS 16, property plant and equipment standard, building revaluation, that will increase the carrying value of the building, that would create a temporary difference. If the carrying value is higher than the tax base, that is a taxable temporary difference, which will lead to a deferred tax liability. If the carrying value is less than the tax base, that is a deductible. I'm talking about an asset. Carrying value is less than the tax base, that is a deductible temporary difference that will lead to a deferred tax asset. So you take the temporary difference multiplied by the tax rate, where you will be getting the deferred tax liability or deferred tax asset. Why I said this, why I discussed this is, let me go back to the other comprehensive income statement because to highlight one point here. Because a lot of items in the other comprehensive income is given net of tax here. Net of tax. Again, net of tax. Which means the deferred tax expenditure is adjusted when you are taking the value of these items into the other comprehensive income. You have taken the gross value and you have deducted the deferred tax impact. Because most of the items in the other comprehensive income doesn't have a current tax impact. You don't need to pay taxes to the inland revenue depending on the fair valuation of these items. So most of the times, if you have a tax impact on the other comprehensive income, that is coming from the deferred tax. That's why I mentioned that. So have a look on the deferred tax adjustment, especially with regard to the revaluation of property, plant, and equipment, revaluation of building. Okay, so ensure that you can deal that adjustment well in the exam. Okay, right. Coming back to the place where I was at. Yeah, this is the one. So what I want to tell you is how to calculate the deferred tax asset or the deferred tax liability, DTL or DTA, deferred tax liability or deferred tax asset, is equal to temporary difference into tax rate. So in Sri Lanka, the tax rate is 28%. Right, sometimes back, now it has been changed. Right, so whatever the tax rate you have, you multiply it by the temporary difference. Then you are getting the deferred tax liability or deferred tax asset. If the temporary difference is a taxable temporary difference, then it's a deferred tax liability. If the temporary difference is a deductible temporary difference, it's a deferred tax asset. And normally the deferred tax liabilities and the deferred tax assets are recognized through the profit or loss. Let's say if you create a deferred tax liability, you credit the deferred tax liability and debit to the P&L. Most of the times you debit to the P&L, right? Most of the cases, but there are certain instances where the deferred tax impact is recognized in the other comprehensive income. Through that it goes to the equity. Example, if you have a deferred tax impact on revaluation, so that is recognized in the other comprehensive income. Okay, that is recognized in the other comprehensive income, because revaluation gain is taken to the other comprehensive income. Through that it goes to equity reserve called revaluation reserve, right? So if you have a relevant deferred tax impact on that revaluation gain, that deferred tax also you need to take to the other comprehensive income. Through that it goes to the equity reserve. Okay, so then so the deferred tax is recognized in the OCI if relates to an item either you recognized in the other comprehensive income or in equity. Example is deferred tax impact on revaluation of PP&E. Finally, there is one location where the deferred tax impact is recognized in goodwill. That is if you have a deferred tax impact on the business combination, which means when parent is acquiring a subsidiary, parent wants to fair value the subsidiary's identifiable net assets. Fair value means now the fair valuation in the opening consolidated balance sheet means carrying value of the assets are increasing now. Again, the tax base of these assets of the acquired subsidiary won't change, because for the tax purpose, you ignore these value gains and losses. Now, carrying value increase, tax base remain change, again there would be a deferred tax impact. So such deferred tax impact on the acquisition of a subsidiary, you recognized in the goodwill. Okay, right. Then, when we were going through the other comprehensive income, we looked at there's a fair value gain or a loss with regard to a cash flow hedge. Right? So, like giving a bit of information about the hedge accounting model, you have 3 hedge accounting models: fair value hedge accounting model, cash flow hedge accounting model, and hedge of a net investment of a foreign operation. Okay, so in one of the video which we have recorded and uploaded into the Infinity Space site, I have discussed a question with regard to a fair value hedge, where you can go through that question. That is a question which was there in the pilot paper. Okay, so I discussed the question. You can have a look on that video and understand about the fair value hedge accounting model. Right, so this particular question is not about the fair value hedge accounting model, cash flow hedge accounting model. Okay, so in the case of cash flow hedge accounting model, what you do is, in hedge accounting you have 2 items. One is hedge item, the other one is what? Hedge instrument. Hedge item creates the risk, creates the gain or loss. Hedge instrument is to offset the risk created by the hedge item. For hedge instrument is normally a derivative, right? It can be a forward contract, it can be a swap, it can be a future derivative. Now, if hedge item create a gain, instrument create a loss, vice versa. Okay, hedge accounting is all about the offsetting. Now, in the case of cash flow hedges, you should understand what is the accounting treatment to be followed with regard to the cash flow hedges. Okay, so in the case of cash flow hedge, what we do is at the end of the each reporting date, you fair value the hedge instrument. Derivative you fair value. And fair value gains and losses of that particular derivative, value gains and losses of that particular derivative, you recognized in the other comprehensive income. You recognized in the other comprehensive income. Then you do one thing, that is So the cumulative fair value gain or loss of the hedge instrument, you compare with the cumulative gain or loss of the hedge item as well. For an example, let's say from the inception of the cash flow hedge, fair value gain of the hedge instrument, let's say 10,000 rupees. I'm taking an example. On the other hand, loss created, or let's say loss created, let's say this is a fair value loss created by the hedge item, let's say rupees 9,000. If this is the situation, now normally what do is you fair value the hedge instrument and the value gains and losses are taken to the other comprehensive income. But in this situation, you see fair value, cumulative fair value gain of the hedge instrument is higher than the cumulative fair value loss of the hedge item. In this situation, what do is out of 10,000, you take 9,000 here to the other comprehensive income. 1,000, that is the excess fair value gain. Comparing with the fair value loss of the hedge item, the excess amount you take to the PL. Got what I say? But let's say if this value is not 10,000, if the value is 8,000, if the value is 8,000, then no problem, because entire 8,000 you take to the other comprehensive income, which is less than the 9,000. Right? That is what it is clearly mentioned here. So if you look at this particular box, however, if the gain or loss of the hedge instrument since the inception is greater than the gain or loss of the hedge item, then the excess gain or loss is taken to the profit or loss. Excess gain or loss is taken to the profit or loss. Right. Coming back to this example, let's say 9,000 you have taken to the other comprehensive income. Then this 9,000 through other comprehensive income you take to equity reserve called cash flow hedge reserve. In this question, we had a cash flow hedge reserve. Then this is actually an other comprehensive income item which may be reclassified to the income statement in a future period. That means once the forecasted cash flow transaction occurs, what is included in the cash flow hedge reserve, you reclassify to the P&L through other comprehensive income as what? Reclassification adjustment. Which means initially value gains are taken to the OCI. Through that, it is accumulated in equity reserve called cash flow hedge reserve. Thereafter, in a future date, once the forecasted transaction occurs, value accumulated in the cash flow hedge reserve, you reclassify to the P&L through other comprehensive income as a reclassification adjustment. So this is the technical aspect of the cash flow hedge accounting. As I mentioned, please go through these areas. Okay, value hedge accounting model, cash flow hedge accounting model. Okay, these are the two main hedge accounting models. Okay, there is one more model called what? Net investment hedge, but what is most important when it comes to the examination is value hedge accounting model and the cash flow hedge accounting model. Right. Okay, so that's about the fair value adjustments and the accounting and the auditing implications that would arise. Okay, in this particular case study question. Let's move to the next area. That is about the power plants. Okay. In the question, it was mentioned that this company, okay, invest in 5 power plants actually, right? Initially, 450 million is invested in 2 windmill plants, okay, and thereafter they have invested another 3 windmill plants where the total investment, okay, subsequently added in 2016 by investing another how much? 700 million. Now, altogether, they have 5 windmill plants. Right? Then there's an additional information in the question where it says that, so the power and the energy sector have 5 windmill plants in MENA that generate 5 megawatts, right, using the renewable energy. Then energy is supplied to the national grid. And this is the point we are into need, not. So because of the recent government policies, sustainability of this sector is a question, which means Here, there is a impairment indicator as per LKS 36, external impairment indicator. You have to test these power plant assets of the power plant itself for the impairment. You have an indicator, external indicator. Test the carrying value and the recoverable value. You know, when it comes to the recoverable amount, you can recover the value of an asset in two ways. Either you can use the asset and generate future cash flows. You can take the present value of these future cash flows as value in use, or else you can recover the value of the asset by selling the asset. There you are taking the fair value less cost to sell. So if you are a rational person, you go ahead with the higher option out of these two, value in use or the fair value less cost to sell. If the value in use is higher, if I can generate higher present value by using the asset rather than disposing it today, I go ahead with the value in use. So the recoverable value is higher of these two, value in use or fair value less cost to sell. So then after getting the recoverable value, if you realize recoverable value is less than the carrying amount, what you need to do is you need to recognize the impairment loss in the income statement. So that is the application of the standard to this particular scenario. Right, moving on to the next one. That is about, operating segments, SLFRS 8. So according to the information given in the question, HCL operates in 5 main sectors: FMCG, healthcare, leisure and travel, logistic, power and energy. Right? So when you have different segments, right? When you have different segments, what you can do is you can do the segment reporting, but you need to keep one thing in mind: this particular company at the moment is a private company. So the standard clearly mentioned SLFRS 8 is applicable, mandatory for the listed companies. Now, there's one more information in the present companies thinking about going ahead with this listing. Right? At the moment, if the company is listed, then it's mandatory requirement for the company to follow the segmental reporting. Right? But at the moment, even they are following, even though it is a private company on voluntary basis. Right? So there can be a question out of this area. So where you should be aware about the steps to be followed in the operating segment under SLFRS 8. So there are actually 5 steps. First of all, you need to identify CODM, Chief Operating Decision Maker. So he is the one, or he's the body or a person who makes the decision about the performance of the segments, as well as he's the one who decides the resource allocation to each of the segment. Okay. So maybe your group CEO, or maybe maybe the entire board of directors of the organization can be considered as COD. Whoever body or the person make performance assessment decision and the resource allocation decision within the organization. Okay. Then the second step is to identify the operating segment. So what is an operating segment? You consider something as an operating segment if 3 conditions are met. First one, able to earn revenue. Second one, whose results are reviewed by CODM. Third one, discrete financial information is available. Upon satisfaction of these 3, you identify the operating segments within the organization. Right? You might identify number of operating segments. Let's say 15 operating segments. Then what you do is in the step number 3, based on the similarity in the economic characteristics, risk factors, and many different factors which you need to look at. So you aggregate these operating segments. Maybe these 15 identified operating segments, I can aggregate into, let's say, 5 to 6 operating segments, aggregated operating segments. Then thereafter, in step number 4, out of these aggregated operating segments, we look at what are the material operating segments based on the threshold test, which I'm going to discuss in a little while. Threshold test. You do the threshold test based on the revenue, based on the profit or loss, based on the assets. You identify what are significant. Okay. So you identify, you determine the reportable operating segments. Then you make then you disclose the information about the reportable operating segments, as well as if let's say there are 2 segments or 3 segments which are not material, you can club them together and show under the other segment. Okay. So that is actually in nutshell. I have given a brief about the standard. Okay, so I hope you have learned these areas quite well. Then this information is given in the pre-scene, right? So FMCG, healthcare, leisure and travel, logistics, power and energy, and the total company. So you have been given the information about revenue, you have been given information about the gross profit, then the segment profit before tax, and the assets and the liabilities, total assets, total liabilities, right? Now, what I want to tell you is basically examiner can test, okay, if we want to go into too much of technicalities, this threshold test, what I highlighted in step number 4, right? What these threshold tests are is, so first of all, you have individual threshold tests, revenue test, profit or loss test, asset test. Then thereafter, you have a consolidation revenue test as well. So let's look at this with the numbers during this question. First of all, individual tests. Revenue test mean what you do is you take the, now this is the total external revenue, 32 million, right? Out of that, you take what? 10%. So 10% out of 32 million, 3,205,430. This is my threshold. This is my threshold as per the individual revenue test. Here you take only the external revenue in the individual revenue test. So if any aggregated operating segment is above this threshold, that particular segment would become a reportable segment. Now, if I go back, you see FMCG. What is the revenue of FMCG? 2020 current year, above the threshold, reportable. Healthcare, above the threshold, reportable. Leisure and travel, above the threshold, reportable. But what about the logistic, power, are below the threshold, right? These are below the threshold here. Then they are not become reportable. So these three would become what? Reportable under the revenue threshold. So I would say here, FMCG, healthcare, leisure and travel are reportable segments. Then if I go back, you don't need to satisfy all three conditions, either the revenue condition or profit or loss condition. If the revenue condition is not satisfied with regard to the two segments, that is logistics and power and energy, now I'm going to look at whether the profit or loss threshold is satisfied, because satisfaction of one out of these three criteria are enough, because it is O, either revenue or profit or loss or assets. Now let's look at how the threshold test of the profit or loss would work. That is, what you do is you take 10% of very important absolute profit. That is, without taking the segments which make losses, you take the segments which make profits only. Now, what are the segments which make profits? 2020, if you look at the segments which make profits, this one, FMCG profit, healthcare profit, leisure and travel profit. But logistic loss, right? Power and energy loss. Without the loss-making segments, you take the total of FMCG, healthcare, and leisure and travel. So what is the total absolute profit? Total absolute profit of these three segments, 2,289,306. Out of that, you take 10%, which is 228,931. Right? Then you take absolute loss as well. Absolute means you forget about the sign. Now take the total loss of the loss-making segments. What are the loss-making segments? That is this, logistics and power and energy. I'm taking these two. So absolute amount, forget about the sign now, 25,643 plus 19,873. You take the total here, right? So if you take the total of these two, that comes to 45,560 absolute loss. Forget about the profit-making sectors, take the loss-making sectors total. Out of that, take 10%, which is how much? 4,552, 10%. Earlier, 10% of absolute profit, 228,931. Out of these two figures, what I take is the higher figure. What is the higher figure? Absolute profit is high. That is my threshold. That is my threshold. Now you look at the two segments which have not been reportable earlier, or whether it is becoming reportable under the profit threshold. That is absolute amount. Now forget about the sign. Absolute profit or absolute loss of that segment should be more than 228,931. If I go back and look at this logistic, is it above the threshold? No. Forget about the sign. 25,643 below. Then 19,873 below. Again, those would not become what? Reportable under the profit or loss criteria as well, right? Then you look at the third one. You looked at this, you looked at this. Now I am looking at the asset. Again, take the total asset value of all the segments. I would say total asset value, I can take actually the company asset value even 21,377,829. Okay. Out of that value, I'm taking what? 10%, which is 2,137,783. Now this is my threshold. Now, yet again, I'm going to look at the rest of the two operating segments, because I don't want to look at FMCG, healthcare, or leisure again, because why? Those have anyway now become what? Reportable under the revenue threshold, external revenue test. So I don't need to look at them again, right? I don't need to look at them again. I'm looking at logistics and power. I looked at logistic and power, right? Under the profit or loss threshold, it is not reportable. Now I am looking at logistic and power under the asset threshold. Under the asset threshold even, so the threshold is now how much? If I go back again, 2.1 million. But if you look at the asset value here, logistics below the threshold, not reportable. Power and energy below the threshold, not reportable. You see, it is not becoming reportable under asset threshold as well. Now, technically, right? Technically, now what has happened was FMCG, healthcare, leisure and travel has become reportable under the revenue threshold. And FMCG, healthcare, leisure and travel, I don't need to check about the profit or loss threshold or the asset threshold because not required. Satisfaction of one criteria is enough. But logistic and power and energy has not become reportable under any of the threshold test individually. Now entity can make a decision actually what to do with the logistic and the power and energy. If entity wants, you can club these two together, logistic and the power and energy together, and you call that as other segment. No need to separately present that logistic and the power and energy. Okay, is that clear with you? Is that okay with you? Then what we need to do is, if you make the decision, let's say you make the decision to show logistic and power and energy, club them together under the other segment. If you put anything under the other segment, then you need to go for the consolidation revenue test as well. Consolidation revenue test. Okay, in the consolidation revenue test, what you consider is external revenue of the all segments, all reportable segments, whether the external revenue of all the reportable segment is more than 75% of the company's total external revenue. Remember, actually in the case of individual revenue test, okay, in the individual revenue test, you consider both external plus internal revenue. Okay, external plus internal revenue, because you can have revenue by selling to another group company. That is kind of an internal revenue. So when it comes to the group accounts, those are getting eliminated. But when it comes to the consolidation revenue test, remember, you take only external revenue. Okay, external revenue. But here you don't have any information about the breakdown of external revenue or internal revenue. But if examiner goes into that technicality, where you should be aware. Okay, so remember. Now, in the consolidation revenue test, let's assume now you consider, but in this particular question, they haven't done that. What they have done was even the logistic and power and even the logistics and power and energy presented separately. Okay, but let's assume we can put that under the other segment. Then you need to do the consolidation revenue test. Then where you need to look at how much is the external revenue of the reportable three segments, that is FMCG, healthcare, and leisure and travel. So I'm taking the revenue of these three reportable segments. Here 12.8 million. This one is 10.8 million. Leisure and travel 3.8 million. Take the total of these three. What is the total of these three? If I add them together by using the calculator, 12, 821, 650 plus 10, 898, 403 plus 3, 846, 495. So how much? That comes to 27,566,548. Right? You divide this by the total external revenue of the company. What is the total external revenue? I believe entire thing is external revenue, right? 32,054,126. Correct, right? 32,054,126. You take the percentage here. What's the percentage? 32,054,126, which is how much? 86%. Right. So to satisfy the consolidation revenue test, your reportable segment's external revenue should be more than 75% of the external revenue of the entire company. So here the consolidation revenue test is what? Satisfied, no problem. I can put logistic and power and energy under the what? Other segment if I want. I can do that. Right? So remember, right? So in the individual revenue test, again I'm repeating because might have been I mispronounced earlier. So in the individual revenue test, you take both internal and the external revenue, right? As I mentioned here. But in the consolidation revenue test, I'm taking only the what? External revenue. And the consolidation revenue test is satisfied. That is what it is mentioned here. Consolidation revenue test means external revenue of the reportable segments should be more than 75% of the entity's total external revenue. But if entity believe that, okay, if entity believe that these two segments, that is logistics and power and energy, even though they are small at the moment, those are important segments where it is important for the organization to provide information about the logistic, power and energy separately. Then management can make a judgment call, even though they are small, if the information is useful to the users of the information, entity can report them separately. There is no restriction. Okay, so if I go to this particular slide, it's clearly mentioned report separately if the information considered useful, even though none of the threshold tests are met. So in this case, none of the threshold tests are met, and the consolidation revenue test is also satisfied. But still, if you believe that the information is useful, management can make a decision to report them separately. And I told you all about the other segment. In all other segment, you club all the aggregated segments which are not reportable as per the revenue, as per the threshold tests. Okay, so I have given you basically brief explanation about how the segmentation work under SLFRS 8. There can be a question out of that area. Okay, moving on. Right. Now, the most recent accounting standard which was introduced in the last financial year in the country is what? SLFRS 16 leases. When you are going through the balance sheet, we looked at there was a right of use lease assets on the balance sheet, right? So in a lease, two parties, lessor, that is the party who provide the asset, leasing company, lessee is the customer. Okay, company is the lessee normally. So the question is tested from the lessee side. Now under SLFRS 16, there is no difference between the previous version of the standard, which is LKS 17 and SLFRS 16, because lessors classify the leases into finance leases and the operating leases. And they continue to do that in SLFRS 16 as well. Now, when the right of use the asset is given to the lessee under this new leasing standard, earlier lessee also classified the leases into the finance and the operating leases. Now there is no more a classification by the lessee, the leases into the finance and the operating leases. All are leases. No terminology called finance or operating in the lessee's books. Lessee has to recognize the lease liability and the right of use the asset for all the leases except for two exemptions. What are these two exemptions? One is short-term leases. That means lease period is 12 months or less than 1 year. Or else the particular underlying asset value at the when it is new, it is having a very low value. That is called as low value item. This is short-term leases. And the second one is low value items. Other than these two, all other leases you have recognized by the lessee on the balance sheet. You can't have off-balance sheet leases because earlier lessee's books, operating leases were off-balance sheet items. No liabilities recorded. But now all the leases except for these two, you take into the balance sheet. Okay. So the items which are exempted under these two exemptions are recognized as pure rental arrangement to the P&L on straight line basis. Okay, so what I wanted to tell you is, so there can be a question, maybe within the case study question, or maybe as a separate question in an accounting standard, because you have accounting standard related questions separated. Within that even, the leases can be tested because last year was the first year this standard was implemented in the country. Okay, so before go to the exam, make sure you know each and every aspect with regard to SLFRS 16, especially the accounting from the lessee side. Okay. Then the next information, what is important with regard to the financial reporting in the pre-scene is this acquisition of the foreign company. Actually, it is 35% acquisition. HCL bought how much? 35% share capital of Bangladeshi company. Okay. So where there are some other investors, because HCL bought 35%, that means there are some Indian and Bangladeshi investors as well, remaining 65%. And the value of the investment was given in takas, that is the Bangladeshi currency, and US dollar value is also given. And this is the first overseas venture where HCL has acquired a stake in. Now, with that, there can be a question. And also the acquisition date is important, December 2019. Year end is, so the HCL year end is actually 31st of March 2020. That means before 4 months, this has been acquired. Now, then you have been given the financial statements of this Bangladeshi company, Healthcare Drugs, right? So the figures are given, first of all, in takas, as well as rupee amount is also given, right? Income statement. All the items in the income statement, if you look at, it has been converted at a rate of 2.12, right? Maybe that is the average rate during the financial year to convert the income statement item into rupees, right? Then there's an additional information about the depreciation and amortization value is given. Now the statement of financial position is also given, taka value as well as the rupee value. Okay, so actually all the assets and the liabilities are converted by using the exchange rate of 2.17. This would be the year-end exchange rate, assets and the liabilities, right? So you have PP&E, investment in subsidiary, intangible assets, financial assets, then you have current assets. Then even the liabilities, non-current liabilities and current liabilities have been converted by using the same closing rate. But the stated capital have been converted by using a different rate. Maybe that is the historical rate. Okay. Then you see because as different items are converted by using different rates, right? So there's an exchange reserve created upon the conversion, right? Exchange difference was created upon the conversion. Because if you look at the stated capital, what is the conversion rate? 1,485,000 divided by 750,000. So that is 1.98 here. The liabilities are 2.17, assets are 2.17. Right? That would create a exchange reserve. Then what I want to tell you is this is a 35% equation. So the applicable accounting standard on how to account for this investment is LKS 28, investment in associates and the joint ventures. So we need to understand the difference between the associate and the joint venture. But accounting side is same, because even though it's an associate or a joint venture, the accounting treatment is equity accounting, which means you account this at cost plus share of post-acquisition net asset increase. Cost plus share of post-acquisition net asset increase. So that is the accounting is same, but conceptually associate and the joint venture are two different things. So there can be a question on, okay, how HCL is going to treat this investment in the books, in the consolidated financial statements. So associate means investment over which investor has the significant influence. Normally having a holding of 20 to 50% gives the investor a significant influence, normally. So when you have the significant influence, you can participate the financial and the operating policy decisions of the investor. Right? So the accounting has equity accounting. On the other hand, SL1 talks about joint arrangements. Huh? So joint arrangement means you and some other party, or maybe two or more parties, are jointly controlling the activities of the arrangement. Which means, let's say it was clearly mentioned in the question, there are some Bangladeshi and Indian investors as well. You have to look at whether you and some other investors take the decision about the Bangladeshi operation with the unanimous consent. So the relevant activities of the foreign operation is decided based on the unanimous consent. If that is the case, so you collectively control that arrangement. Then it's what? Joint arrangement. Right? Unanimous consent, important word. Then this joint arrangement, as per the standard SLFRS 11, are two types: joint operation or a joint venture. Here it's a joint venture because why? In a joint operation, no separate entity is established. But in the case of a joint venture, there is a separate entity. Now this Bangladeshi operation is a separate entity. So the parties are having the rights over the net asset of that particular entity. So in this case, HCL is having 35% interest over the net asset of the separate entity. It's a joint venture. In case if HCL is having the joint control with another party or with another partner. So information is not there in the pre-scene to decide whether it's associate or a joint venture, but there can be information in the unseen. Based on the information, you might need to decide it's an associate or a joint venture. Okay. So I told you all, if you have a separate entity and if the parties are having the rights over the net asset of the arrangement, that has to be considered as a joint venture, not as a joint operation. Right. Okay. In addition to that, let me touch upon a little bit about the consolidation of foreign operation. Okay. So if you have a foreign subsidiary, the exam, so the figures are given in a different functional currency, not in rupees. So the parent's currency, let's say rupees, subsidiary is having a different functional currency. So before consolidation, what you need to do is, so this foreign currency financial statements of the subsidiary, you need to convert into the parent's currency. That means into rupees. For the conversion, what you use is, you use the exchange rate. Now, when you are using the exchange rates, different items are converted by using different rates. Income, expenses, and the other comprehensive income items are translated by using the average rate as an approximation. Assets, liabilities are converted by using the closing rate. Share capital, pre-acquisition profits are converted by using the historical rate. Then once the items are converted at different rates, what will happen? There would be an exchange difference. Exchange reserve is created. So this exchange reserve is recognized in the other comprehensive income. Through that, it is accumulated in the equity reserve. called translation reserve. In addition to these conversions, there is another reason where exchange difference arise, because when you acquire a foreign subsidiary, what you need to do is you have to do the goodwill calculation by using the foreign currency. You calculate the goodwill by using the functional currency of the subsidiary. Then this foreign currency calculated goodwill figure, each year end, you have to convert into the parent's currency by using the closing rate, because like any other asset liability of the foreign subsidiary, goodwill is also an asset of the foreign subsidiary. That has to be converted by using the closing rate at the each year end. So if you have gains and losses out of this conversion each year, those gains and losses are also part of the exchange difference. That is also recognized in the other comprehensive income accumulated in value in an equity reserve called translation reserve. Okay, so I just give an introduction about how the exchange difference arise in the case of a consolidation of a foreign subsidiary. Right. Then moving on to the next important information in the preceding analysis with regard to the consolidation, because one of the person called Cicera, he has mentioned a person who is holding a managerial position. He emphasized the importance of what? Acquisitions and partnering, to grow as the regional leader. And also he emphasized getting rid of the non-value adding activities, divestments, to maintain the sustainable growth. So with that information, examiner can give you a question with regard to an acquisition. That may be a mid-year acquisition. That means mid-year acquisition means in this question, the financial year is what? 1st April 2019 to 31st of March 2020. Now, this is, let's say, this is the financial year, right? So during the year, let's say at the middle of the year, exactly the middle of the year, which is on 30th September 2019, there was an acquisition. 6 months here, 6 months here. This is a mid-year acquisition. In the case of the mid-year acquisition, what you consolidate is this period. You have to time a portion, the income and the expenses of the acquired subsidiary, you consolidate in the income statement. Then on the date of acquisition, here you need to calculate the goodwill, and you have to measure the non-controlling interest, either by using the proportionate net asset basis or the value basis. Then when you prepare the statement of financial position on the last date, you prepare the statement of financial position. This is for the income statement. When it comes to the statement of financial position, which is prepared based on the information at the last date. Last date, this subsidiary is under the control of the parent, so you have to consolidate all the assets, liabilities of the acquired subsidiary. Okay, so this is a kind of a mid-year acquisition. Okay, then in addition to that, before moving to the next area, in the recorded videos, what I uploaded into the website, Infinity Space website, where you can register there, open up an account, and watch these videos, right, before go to the exam. With regard to the consolidation related, I have discussed many questions, right? So there's a step acquisition question. I discussed that fully in the pilot paper. Okay. Then there's an adjustment with regard to disposal. I discussed that in detail. Look at that. Okay. So there are like maybe around 10 hours of recorded videos which we have uploaded. So in my area as well as in Dunil's area, that is the other part of SL1, governance part, governance, ethics, and control side. So watch these videos as well, right? Then one more thing I want to highlight here, that is about LKS 27. It is about separate financial statement. We talk many things about the consolidated financial statement, but let me tell you about one important point with regard to this standard, LKS 27. So this standard talks about, now, if you have a subsidiary company, parent company, prepare consolidated financial statement. That's true. In addition to that, parent has to prepare their individual separate financial statements as well. Similarly, parent and subsidiary relationship. Similar to that, you can have investor associate relationship. Investor can have a associate. In the consolidated financial statements, this associate has to be equity accountant, right? So the investor has to prepare, remember, their separate financial statements as well. So that investment has to be recorded in the separate financial statements as well. Okay. Then finally, if you are a joint venturer, you have a joint venture investment. In the consolidated financial statements, this joint venture investment is equity accounted. We looked at earlier. But in the separate financial statements of the venture, how are we going to account? So what it says is, when entity prepare their individual separate financial statements, if they have an investment in subsidiary, joint venture, or associate, in the separate financial statements, this investment can be recorded either by using any of these three measures. In the separate financial statement, it can be recorded at cost. It can be recorded at as per SL1 9, which means at financial instrument standard, you have to fair value. Right? Maybe the fair value gains and losses are recognized in the other comprehensive income. Or else in the separate financial statement, it can be equity accounted. Right? Then the same thing, when you take to the consolidated financial statements, you have to follow the rules as per the consolidated financial statement. IFRS 3. So in Sri Lankan context, SLFRS 3, business combinations, standard. Then the SLFRS 10, consolidated financial statements. Those standards to be followed when you are consolidating this investment at the consolidated financial statements. In the consolidated financial statement, what it says is, if you have a investment in subsidiary, investment has to be measured at the fair value at the date of acquisition. You can't take the fair value at the reporting date. For an example, let's say in the separate financial statement, if I follow this approach, SLFRS 9, which is recorded at the fair value of the investment at the reporting date, but when I go to the consolidated financial statement, I have to take the fair value at the date of acquisition, which is more or less is equal to the what? Cost of the investment. So whatever the entries which I have passed in the individual financial statements might require to reverse when I go to the consolidation level for the goodwill calculation. Same thing is applicable for the investment in associates as well as investment in joint ventures as well. Again, I am not going into much details here because I have done a recorded video. That recorded video is uploaded in the site where you can have a look. I have done a quick. So the consolidation question which I did, it's a long question. So it took me more than 2 hours to explain the entire bit of that question. So you can, so this particular adjustment is there in that question. You all can have a look. Okay. Then, in addition to the acquisitions, if I go back here, he was talking about this person getting rid of non-value added activities. Okay. Maybe organization believe that some of the activities that they are carrying out, maybe the logistic operation, maybe the power and energy sector, is not adding any value. It doesn't have any strategic fit with the other businesses that the company is undertaking. So I might decide to sell one of this SBU, one of this division. Then it would be a discontinued operation. So as per SLFRS 5, to classify something as a discontinued operation, 3 conditions to be met. First one, component, which means the operation and the cash flows of that segment, you can separately identify. Okay, operations and the cash flows are distinguishable for the operating purposes as well as for the financial reporting purposes. It can be a cash generating unit. It can be a group of cash generating units. So some or the other, it can be separately identified operationally as well as for the financial reporting purposes. It is either already disposed of during the year, you sold it out during the year, or else classified as held for sale. Not yet been disposed, but it has been classified as held for sale. I'm going to dispose in the near future. I'm going to dispose this segment in the near future. Held for sale means you are trying to recover the carrying value of that segment principally through a sales transaction. Okay, either disposed of or classified as held for sale. And also it represents separate major line of business or a geographical area. You see, if you dispose power and energy sector, that is what separate major line of business. Okay, so actually under the third point, so this is number 1, I would say, this is number 2, and this is number 3. So I actually simplified the definition of the discontinued operation, right? In the like standard book, it has a very long definition, but I broken down that into 3 parts: component, disposed of or classified as held for sale, then it represents separate major line of business or a geographical area. Or it can be a what? Part of single plan to dispose separate major line of business or a geographical area. That means you are disposing separate major line of business or a geographical area part by part. Or else it can be a what? Subsidiary acquired exclusively with a view to resale. So the when it comes to this third point, satisfaction of 1 is enough, but what is relevant to this question is this part. So because if you dispose power and energy, it is a separate major line of business. So it amount into a what? Discontinued operation. Then looking at the accounting aspects of the discontinued operation, what we do is, now let's say during the year you disposed power sector or you classified the power sector as held for sale. Then the results of the power sector, power and energy sector, you have to separately show from the continuing operation. So the total profit you have to divide. What is the profit or loss from the continuing operation and what is the profit or loss of the discontinued operation? You have to show separately. Okay, so look at the presentations under SL1. Okay, because they are talking about some divestments, non-value-added activities. Right. With that, actually, I discussed most important aspects of the pre-scene analysis. Now I am moving on to the what you call another important area, which is so important comparing or considering the current business environment. Okay, and remember, CA Sri Lanka also issued a guideline on this area, impact of COVID-19 on financial reporting. It has impact on in many areas, operational impact. Okay, so the business impact, and it has an impact. So having an impact on business, having an impact on operations mean obviously it has an impact on what? Financial reporting as well, right? So let's look at that section now. Okay, so make sure you listen this with 100% attention. Okay, so important. Right. So you should understand there is no accounting standard which explains the accounting for COVID-19. There is no separate standard. So the impact is there all over the standards, right? Many standards or many areas have been affected means impact is there for many accounting standards. I have categorized my presentation into headings, okay? Categorized my presentation into different headings where I'm going to look at impairment of assets, measurement of inventory, value measurement of debt and equity instruments, financial instruments. Under that, I'm going to discuss about the expected credit loss assessment and also impairment of trade receivable, measurement of deferred tax assets, events after the reporting period, and the going concern. Let's take one by one now and discuss in detail. Now, LKS 36 impairment of asset. Because of the COVID-19, some of your assets are not utilized in full capacity. Maybe the buildings are idling, machinery are idling, delivery vehicles are idling. You need to check if you have, so all these things are what? Impairment indicators. So if you have the indicators, what you need to look at is check the carrying value with the recoverable value. You know an asset value can be recovered either by taking the fair value less cost to sell. That means you sell the asset today, you are taking the fair value minus the selling cost, or else you consider the present value of the future cash flows. So once you take the present value of the future cash flows, you call that as value in use. Out of these, you take the higher figure. Okay, recoverable value is higher of fair value less cost to sell or value in use. Then you compare this recoverable value. Let's say I'm putting some numbers here. Fair value less cost to sell is 100. Value in use is 120. Now, what is the recoverable value? 120. Let's say my carrying value is 150, which means what? Carrying value is higher than the recoverable value. There is an impairment loss of how much? 30 to be charged to the P&L. Okay, that's it. Simple one, right? Second one, inventory, LKS2, because this organization is having FMCG sector, pharmaceutical sector. They have products, right? So you need to look at whether the net realizable value of the inventory is below than the cost. If the net realizable value is below than the cost, because inventory has to be measured at lower of cost or NRV. If the NRV is below than the cost, what you need to do is you need to write down the inventory value, and that write-off to be recognized in the income statement. You charge that to the P&L. Okay, because of the COVID-19, so these items are there at the closing inventory is unable to sell. So you can't access to the whatever the market where you want to sell this product. Okay, so then write down the inventory up to the net realizable value. Then the third area, which has a bit of a complexity as well, with regard to the fair value measurement of your investment. You can invest in the debt financial assets, or you can invest in the equity financial assets. Example, you invest in a debt financial asset means you invest in treasury bonds, you invest in debentures issued by the companies. Equity financial assets mean you acquire share investments, maybe the quoted shares in quoted company, quoted public companies, or else you acquire the shares of a private company. Now, what happens is, normally, if I take an example of an investment in a quoted public company's share, right, equity instrument. So the earlier I explained, you need to fair value the investment, right? You need to fair value the investment. When you are fair valuing the investment, either you classify this investment as fair value through P&L, that is the normal expectation, but if two conditions are met, I can designate the investment under fair value through OCI. But both cases, what you do is you measure the equity financial asset investment at fair value. Now, when you are measuring the fair value, the guidance are given in SLFRS 13. So the SLFRS 13 says that you have to use the, like quoted price for the identical asset in an active market. Now, when it comes to the current financial year end, what is current financial year end? 31st March 2020, that is the financial year end of HCL, you have a problem. What is the problem? Stock market or the stock exchange is closed. You don't have reliable information to get the what? Quoted prices. No reliable information, unavailability of reliable information. Or else even the transactions are taken place, these are distressed prices, not the arm's length prices. In that situation, can I measure the investment in the equity shares by using the level 1 inputs, by using the quoted prices? That's a question. So because of that, entities are allowed, even though you make an investment in the quoted public companies shares, as the unavailability of the prices as at the year end, as the stock exchange is closed. So you are allowed to use valuation techniques. You can go to the what you see level 2 and level 3, as level 1 inputs are now not reliable. Right? Valuation technique means you can use the free cash flow basis to value the share, or asset-based valuations to value the share. What you should understand here, there can be a lot of manipulations can be happen because it is judgment. So because of that, organizations are required to make a lot of disclosures with regard to the valuation technique, assumptions that they have used. And also, CS Sri Lanka, in the guidelines that they have issued, they put a restriction as well. That is, you can use a appropriate valuation technique, but the fair value that you derive by using that appropriate valuation technique as at 31st March 2020 should not be more than the quoted market price reported as at 31st December 2019. So the value here that you derive should not be more than the market value of the investment recorded as at 31st December 2019. Then the room for the manipulation by using the valuation technique is what? Significantly reduced. So if I read out the last point, however, such value calculated and used as the fair value in the financial statement for the year ended 31st March 2020 by using a valuation technique are not expected to exceed the market value reported as at 31st December 2019. This is the point what I wanted to mention. Okay. Right. Now I am moving to one of the area where students believe that it is a tough area, but it's not the case actually. Right? ECL model, expected credit loss assessment. Right? You know, like if you are a financial institution, your entire loan portfolio. So by looking at this picture, you can understand that. So the entire story is there within the face of this man, right? So the all the financial asset. So you need to divide into 3 sectors. So I would say this is stage 1. Stage 1 means performing loans. Stage 2, these are the loans where the significant increase of credit risk is there. Okay, so some people refer this as non-performing loans. And the stage 3 is what? Credit impairment. Okay. Now, if you are in the stage 1, that means loans are performing, so your borrowers are paying on time. You recognize the loss allowance by using the 12 months expected credit loss model. And you recognize the interest revenue by using the gross carrying value of the loan. So for you to explain about the gross carrying value and the net carrying value, so the gross carrying value is the total value of the loan given. Let's say it is 1,000. Then from this you deduct loss allowance. This is the provision. Loss allowance. Let's say there's a loss allowance of 50. Then the net carrying value is 950. That's how it works, right? So if you are in the stage 1, you recognize the interest income by using the what? Gross carrying value based on the 1,000 into the effective interest rate. You recognize the interest income like that. If the credit risk has significantly increased comparing with the initial recognition of the financial asset, then you go to the stage number 2. In the stage number 2, the difference is it's not 12 months expected credit loss. You have to consider all the loss events which can happen over the entire life of the financial asset. In the stage 1, you look at the loss events which can happen only during the 12 months from the reporting date. But here, you look at if the financial asset has a lifetime of 5 years, you look at entire lifetime. What are the loss events? So based on that, you make the loss allowance. So the loss allowance that you make under the lifetime expected credit loss model is what? Normally higher than the 12 months expected credit loss model. So you are in the stage number 2, so you have to make a higher loss allowance because loan is now non-performing or the credit risk has significantly increased. But still, you recognize the finance income or the interest income based on the what? Gross carrying value of the asset. That means based on 1,000 still. If you go to the credit impaired stage, that means default occurs, customer or the borrower is not paying, credit impaired, then the loss allowance should be based on the lifetime expected credit loss model. And the change here is you recognize the interest income based on the what? Net carrying value, based on what? 950 into the effective interest rate. Okay, so the loss allowance value can also be changed. So here I have taken, if it is stage 1, loss allowance is 50. That is 12 months expected credit loss. But when you go to the lifetime expected credit loss, your loss allowance would be normally more than 50. Maybe it is 150. Okay, so I wanted to explain you the concepts. Right, so this is actually the background of the impairment assessment of the financial assets, especially by the financial institutions. Now, the impact of COVID-19 is what? So during the period or during the affected period, government has given a lot of moratorium, government introduced, and a lot of economic relief measures have been introduced. Where now, if I am a financial institution, my borrowers are given this moratorium, economic relief. So because of that, what they do is they are taking the benefit of this moratorium and they are not making the interest and the capital repayment to the financial institution. Right? Now the normal rule is normal rule. I'm talking about the normal rule first. Right? Normal rule is that is, let's say under the normal rule, if a borrower, okay, doesn't pay me more than 30 days overdue. That means if a borrower, there's a due date. So from the due date, after even 30 days, if borrower has not paid me, then there's a reputable presumption that loan has to classify from stage 1 to stage 2. Reputable presumption. Reputable presumption means it's a challengeable presumption. Normally, if it is more than 30 days due, it goes to what? Stage 2. Now, let's say there's a particular borrower with the relief measures, with the relief measures introduced by the government, he's not paying me, maybe for 3 months' time. Okay. Now, can I classify this loan as stage 2 loan? Can I say that this is a loan where the significant credit risk has increased or the credit risk has significantly increased? I can't say that, right? Because he is taking the moratorium loan. He would be a good company, doesn't have much of an impact. So if he's not going to pay me for more than 30 days, remember that presumption is what? Reputable, challengeable. It's challenge. So the financial institution can challenge the assumption. They can say that even though this customer is not going to pay me for more than 30 days because he's using the moratorium. So I don't want to classify the loan into stage 2 because bank managers or the banks doesn't want to classify the loans into the stage 2, because if the loans are classified into stage 2, loss allowance will be higher. Why the loss allowance would be higher? Because stage 2 means lifetime expected credit loss. Understood? Now read this carefully. Assessment of significant increase in the credit risk. That means stage 2. Right? There is a reputable, challengeable presumption that the payment default for more than 30 days past due provides evidence for the significant increase in credit risk. However, preparers may consider whether the specific circumstances related to COVID-19 outbreak and the associated economic support and the relief measures constitute sufficient justification to rebut this presumption. Okay, so if you have enough information to challenge the assumption, you can say that even it is more than 30 days overdue, still it is in the stage number 1. I hope you understood. Then going back about the stage number 3. Similar to stage 2, if a particular loan is more than 90 days overdue, normally what do you do is, normally you classify the loan into stage 3. You put that under the stage 3 normally. But again, it's a reputable assumption. Okay, during the COVID-19 outbreak period, there's a borrower, it's a good party. He's using the moratorium given by the government, maybe a highly affected sector, maybe let's say leisure, tourism. He's not going to pay me for 6 months period. Then if the loan is outstanding for more than 90 days, can I say that I have to put the loan under the stage number 3, credit impaired, recognize the lifetime expected credit loss, and recognize the interest income based on the net carrying amount? No, you can challenge the assumption again. He's not paying me, yes, because he's using the moratorium. So I can still continue to keep the loan under stage 1 or stage 2. I don't want to put under the stage number 3. You got what I say? Yeah. So go to this slide. Stage 3, assessment of default or the credit impaired. Stage 3. Right, this is stage 3. There is a reputable presumption that payment default of more than 90 days past due provide evidence of default. Again, reputable. You can challenge. preparers may consider whether the specific circumstances related to COVID-19 outbreak and the associated economic support and the relief measures provide sufficient justification to what rebut the default assumption. Whether you can challenge. If you can provide the justified evidence, you don't want to put that under stage number 3. Right. Important area, right? Okay. If it's a financial institution. Then not only financial institutions, like let's say if you take a manufacturing organization like HCL, right? So for them, even they have trade debtors. So if they have trade debtors, sometimes these trade debtors, like there can be trade debtors when it comes to the reporting date, they are long outstanding because you have given them 30 days to pay, but some of the customers are taking more time to make the payment. That is before the COVID-19. But with the COVID-19, now what has happened was the situation has become even worse. It is difficult to collect them now, more than difficult than previously. It was difficult anyway. Now it is much more difficult. So they even don't answer your call, right? No response at all. Then what entity has to do is, if you have trade receivable is a financial asset. You need to look at whether you need to increase the loss allowance of your trade receivable portfolio, or else whether you need to do any write-offs. If there's a particular customer who is bankrupt, you got to know that he's bankrupt because of this impact. Entire business is collapsed. So you have to record the write-off. Okay, management will need to revisit their estimates on the implied write-offs and implied write-off for the long outstanding borrowers. As a result of COVID-19 impact, the probability of collection of these amounts may be further decline. Okay, impairment of trade receivable. Loss allowance has to increase or write-offs to be recognized. Right. So these are the areas which is important of this COVID-19 impact with regard to SLFRS 9. Okay. Right. Moving on to the next element, that is about the deferred tax assets. I discussed this concept of deferred tax earlier, deferred tax liabilities and deferred tax asset. The theory is, if you have a deferred tax liability, accounting standards are developed based on the prudence concept. If you have a deferred tax liability, what do is you recognize in full. But if it is a deferred tax asset, you recognize if recoverable. What does that mean? Think about a tax loss. There's a company which you have started in the last financial year, and the company has made a tax loss. Let's say tax loss of, not dollars, let's take rupees, right? Okay, company has made a tax loss of rupees, let's say 1 million. 1 million tax loss. So once you make a tax loss, what you can do is this tax loss you can carry forward for the next financial year and set off against the future profits. That means in future, when I have tax profits, I can set off this tax loss and I can pay less taxes in the future. Deferred tax adjustments are all about whether I need to pay more taxes in the future or whether I need to pay less taxes in the future because of a temporary difference. Now, tax loss is a scenario where because of the tax loss, I need to pay less taxes in the future because I can set off this tax loss once the tax profits are available. So because of that, what the organization has done was, so this tax loss, they consider that as a deductible temporary difference. So it seems that it is difficult, it's very difficult for them to make profits in the future. Because for you to recognize a deferred tax asset with regard to a tax loss, you should be pretty sure that you make the profits in the future. If you make the profits in the future, then only you can what? Recover the tax loss. So that's why it's clearly mentioned you recognize the asset if it is what? Recoverable. So the way of recovering the tax loss is only if you make tax profits in the future. Before the COVID-19, you are pretty sure, okay, this is the first year I made a tax loss because there are a lot of non-recurring expenditure I need to incur in the first year. But from the second year onwards, I'm going to make profits. That was my estimate. But due to the COVID-19 impact, the sector is largely affected. Now, under the Sri Lankan law, you can carry forward the tax loss current year and only for a 5 years period. You can't carry forward more than that. Now the future is uncertain. And you believe that it is very difficult for me to make tax profits. And if you can't make the tax profit, you can't recover this tax loss. Then there's a question mark on this value of the deferred tax asset that you have already recognized on the balance sheet. Okay, if you can't estimate, you can't make profits. If you can't estimate making the profits in the future, then I can't keep this deferred tax asset on the balance sheet. That has to be what? Write off. Okay, so the entities who have unused tax losses, on top of that they recognize the deferred tax asset, they have to reassess their assessments and see that whether these unused tax losses can be recoverable with the future tax profits in the following current year and the following 5 years. Okay, right. Here it's clearly mentioned whether it is probable it will have taxable profits before the unused tax losses are expired. We need to look at. Right. Then next area which is affected by this outbreak, COVID-19 outbreak, is events after the reporting period. Now, what is the reporting period in our question? It is 1st April 2019 to 31st March 2020. Now, the pandemic impact has come actually in the month of March. So when it comes to Sri Lanka, right? That means when it comes to the report date, the condition of the pandemic was existed. No? So by this date, condition was existed. Then if that event happened during the period from 31st March to the date where the financials are authorized by the management, let's say this date where the financial statements are authorized on 30th, let's say May 20, 30th May 20. So if there any event happened during this period from 31st March to 30th May, right? So that particular event, as per the standard, we need to decide whether it is an adjusting event or whether it is an unadjusting event, because the period covered by LKS 10 is from the date of the reporting period to the date where the financial statements are authorized for issue by the management. So all the events which are happening during this period, either you need to consider as an adjusting event or non-adjusting event. What do you mean by adjusting event? Adjusting event means event which provides further evidence on the condition existed on the reporting date, so that you adjust your financial statements. Non-adjusting event means that is an event which provides new evidence where no condition was existed at the reporting date. So if a particular event is a non-adjusting event, you are not going to make any adjustment to the financial statement. What you do is you make a disclosure with regard to the event in the financial statements. Disclosure about the event and estimated financial impact. Now, according to this current situation, if you are a 31st March year-end company, right, let's assume you have a receivable balance. On this date, you have a receivable balance from a foreign customer. Let's say receivable balance is rupees 100,000 from a foreign customer. Receivable balance. Okay. Now, it's a foreign customer. Then during the events after the reporting period, that is after the year end, before the financial statements are authorized for issue, let's say somewhere in early May, you identify this customer is bankrupt. Now, the receivable balance that is there on the balance sheet, what are you going to do? Are you going to keep that, or are you going to write off that? If it is an adjusting event, I can write off. If it is an unadjusting event, I just need to make a disclosure. What do you say? It is an event where the condition of the pandemic was existed at the reporting date. Because of the pandemic, he has bankrupt. Now, this provides further evidence on the condition existed on the reporting date. So you need to make the adjustment into the financial statement. You have to write off the debtor balance, charge that to the income statement. Debit income statement, P&L, 100,000, credit the receivable. Are we clear? Understood? Okay. Then for you to explain this, I'll take a different year end. Let's assume, right, to explain to you all, because this point is there in the guideline issued by CS Sri Lanka with regard to this matter. So I'll erase this information, what it was written here. Okay. I'll erase info. I'll take a new example. Let's assume you are a 31st December year end company. Because as I mentioned, this COVID-19 impact can be tested within the case study question as well as in the separate question where the accounting standards are tested. Okay, so that's why I'm discussing this in detail. Okay, so let's say you are 31st of, your year end is 31st of December. That means 1st January 2019 to 31st December 2019. Now what do you say? So your financial statements are authorized for issue, let's say 27 February 2020. Now this is your events after the reporting period, from the reporting date to the date where the financial statements are authorized for issue by the management. Now take the same example. You have a receivable balance of how much? 100,000. Same question. Receivable balance. This is from a foreign customer. Now think about the Sri Lankan context. 31st December 2019, did we have the condition of the pandemic? We did not have, right? We didn't have the pandemic condition. Now, during the month of January or February, you identify this receivable. Foreign customer is not going to pay you. He's bankrupt. Now, for the 31st December year-end company, tell me this is an adjusting event or non-adjusting event. Was the condition existed at the reporting date? Unless otherwise, this receivable balance is from China. Unless otherwise, it is from China, condition was not existed. Let's say the receivable balance is from US customer. Condition was not existed as at 31st December. So if the condition was not existed, you are not going to adjust your financial statement. You are not going to recognize the write-off in the financial statements. You make a disclosure in the financial statements about the event and the estimated financial impact. Did you understand the point? So this is the point what I want to mention. So the next slide explains that in detail. So all the events which are occurring after the reporting date, before the financial statements are authorized to issue, either considered as adjusting or non-adjusting. Adjusting means provide evidence on conditions existed at the reporting date. Non-adjusting means these are the conditions arose after the reporting period. Adjusting events adjust, non-adjusting events disclose if the information is material. I hope you understood about it. Then this is the explanation of what I explained actually. Impact of COVID-19 is generally a non-adjusting event for periods ended 31st December 2019. Consequently, there would be no impact on the recognition and measurement of assets and the liabilities in the financial statements. For the reporting periods ended 31st March 2020, this is where our company's HCL. COVID-19 was an event that existed and caused an impact to the operation at or before the reporting date. Events subsequent to the reporting date should be accounted as a adjusting event. That is relevant to our company's year, as it has a year end of 31st of March 2020. Right. Then about the COVID-19, the final area what I want to touch upon is going concern. You know, when preparing the financial statement, you believe an organization exists for a foreseeable future. Okay, so that's why you classify your assets into current assets and non-current assets. Current means within 1 year. Non-current means more than 1 year period. Okay, then the liabilities into current and non-current, because you assume it existed for a foreseeable future. But sometimes, if the pandemic is so severe in certain sectors, there is a question mark on the going concern ability of the organization. Might have been these events have been taken place after the year end, after 31st of March. But before the financial statements are authorized to issue, after 31st of March, before the financial statements are authorized to issue, you got to know that I can't continue the operation. The impact is so severe. So I have to what? Close down. In that situation, what you need to do? You have to go back and adjust your financial statements as at 31st of March, and you can't prepare the financial statement by using the going concern basis. You have to use the breakup basis. What do you mean by breakup basis? You have to classify all assets, all liabilities into current assets and the current liabilities. You can't have non-current assets. You can't have non-current liabilities. And your valuation of assets, long-term assets, you have to evaluate the realizable value. So there would be what significant write-offs, because realizable value, net realizable value would be what less than the carrying value. So you have to do the write-offs. You see, a lot of changes are to be taken place if the going concern assumption is invalidate because of the COVID-19 impact. All available information shall be considered about the future, which could obtain after the reporting date, including the measures taken by the government and the banks to provide the relief to the affected entities in the assessment of going concern. When you are assessing the going concern, look at the ability to continue because of the relief measures given by the government, given by the banks. So even after considering the relief measures, still if you believe that I can't continue, then you can't prepare the financial statement by using the going concern basis. If the management concludes that consequences of the outbreak will result deterioration in operating results and the financial position after the reporting date, even after the reporting date, that is so severe that the going concern assumption is no longer appropriate, then the financial statements should not be prepared on going concern basis. So you have to reclassify all assets and the liabilities as current, significant write-downs in the long-term asset values. Right, so that's what I want to present. But one important thing before moving here, this organization has different SPUs. So that means they have different revenue streams. For an example, FMCG sector. So the revenue recognition of the FMCG sector, SLFRS 50. You recognize the revenue once the control is passed. Then you have this what you call hotels. So the leisure sector. With regard to hotels, you have different revenue sources. One is occupancy of the room. Let's say once a customer make a booking. Now, normally hotels are getting an advance. So once the advance is received from the customer, can hotel recognize that as revenue? No, that is a deferred income. It's an advance receipt. You have to keep that in a balance sheet liability account. You recognize that advance into the revenue only when the room is occupied. Guests come and occupy the room. Based on the occupancy only, you recognize the revenue. Up until that, it's a deferred income. Then with regard to the hotels, you have another revenue source, food and beverage. Food and beverage, you recognize when the items are provided to the customers. Okay, then and there, when you provide the foods, when you provide the beverages, you recognize the revenue. Then it might have another revenue source, would be a spa service. So that is recognized again once the service is rendered. Okay, and also especially talking about the Sri Lankan contest example, Hemas, right? So they have like certain airline agencies as well as shipping agencies. Then the revenue recognition with regard to the agent is applicable, because when it comes to the agent, okay, when it comes to the agent, the revenue is the commission that they receive. Now, with regard to a particular airline, if you are the agent, okay, if you are the agent, your revenue is not the total amount what you collected from the customer. Your revenue is the commission, maybe the percentage that you agree with the principal. So that would be applicable. right? So these are the other areas which examiner can focus on in the exam. Right, with that, I actually come to the conclusion of my presentation. As I mentioned earlier, you can visit a lot of videos. Myself and Indunil has done around about like 10 hours videos. So those are very important, really targeting on the upcoming examination. We discussed the pilot paper as well as certain module questions. So where you can find out these videos in the Infinity Learning space, right? So before conclusion, so if you all have any questions, now you all can type the question through the chat box where I can answer these questions. Yeah, there are some requests made to upload this presentation. Yes, definitely we will upload. You all can download in through our website, access to this Infinity Learning Space website, where you need to create an account, and through that you have to logging in and watch the videos as well as you can download the PowerPoint presentations. And we will upload the video as well, where you can listen to the recorded or the what you call recorded version of the video as well. Yeah, there's a question with regard to what about earning per share. Yeah, because earning per share was disclosed in the financial statement, right? So there can be a question like maybe you should understand how to calculate the earning per share. First of all, basic earning per share, basic EPS, and the diluted DPS. Basic EPS calculation with regard to a share issue and share repurchases. Basic EPS calculation with regard to a bonus issue. Basic EPS calculation with regard to a rights issue. You should be aware. Then thereafter, what is the meaning of the diluted EPS? How to calculate the diluted EPS when you have potential lower shares, like what convertible debentures, convertible preference shares, share options, diluted EPS calculation can be tested as it is mentioned in the question EPS. What standard should we focus more on? Question number one. I'm not recommending you to like spot out the questions or the areas because it can be from anything, but I would say that the important areas would be, yes, financial instruments are important, then in addition to that, I have highlighted the other areas of the case study which would be important, right? So it's difficult to say these are the standards that are going to be tested, right? But I would say that the financial instrument and consolidation are important. Okay. With regard to the recent introductions, as I mentioned, SLFRS 16. Okay, I should highlight that, right? So the answer to the question, financial instruments, consolidation, then the SLFRS 16 leases, because it has been issued recently, right? And also the other two recent standards, that is SLFRS 15, revenue recognition, okay, and SLFRS 9. These are the most recent three standards which have been introduced, 9, 15, and 16. Okay, possibility of testing is high. Right, so there's a question about the events after the reporting date. Example, what I have mentioned, what I want to tell you is 31st March 2020 year-end company, that is an adjusting event. Condition was exceeded at the reporting date. You have to adjust the financial statements. You have to record the write-off. But if your year-end is 31st December 2019, right, where the condition was not existed. December in Sri Lanka, we didn't have this pandemic matter. So if a foreign customer which was existed at 31st of December is bankrupt subsequently for a 31st December year-end company, it would be a what? New event. Condition was not existed. If so, they are not going to adjust the financial statement. They just make a what? Disclosure about the event. It is an unadjusting event for a 31st December 2019 year-end company, unless otherwise receivable balance is from China. If it is a Chinese receivable, even at 31st December 2019, condition was existed in China. Then if there is a write-off of a Chinese customer receivable balance from a Chinese customer, that would become a adjusting event. Normally, when it comes to expected trade loss, if it's a calculation, examiner will give you this is the loss allowance, or else if it's a calculation, it's a very simple calculation, right? Won't go into a very detailed calculation. Then there's another question with regard to financial statement analysis, whether to take the bank overdraft into the gearing calculation. So for the gearing, normally what do you take is interest bearing long-term debt. Bank OD is not taken, but if you are not sure in the exam, so always write how did you make the calculation. Then examiner will give you full marks. If you are excluding the OD, you mention that you excluded the OD as it is a short-term obligation. Normally what we take is bank loans, lease obligations, debentures, those sort of stuff. Right. I hope the session is, so the session was useful to you, right? So the exams are coming in next week time, right? So if you need further information about the Infinity Space or the videos or anything, so you have the contact number in the website where you can get to the administrators through there, through that contact number. So I wish you all the best for the exam and future to become a prestigious chartered accountant, right? Okay, with that, we'll wind up for the day. So see you. Good night.